Revenue can be managed, earnings can be massaged, but the balance sheet doesn't lie if you know where to look. Most investors scan the income statement and stop there. The balance sheet is where the real story hides. Rising debt, eroding cash, receivables that aren't getting collected, inventory nobody wants to buy. Today I'm showing you how to use AI to scan any company's balance sheet for the warning signs that most investors miss until it's too late. Welcome to the AI portfolio. I'm showing everyday investors how to use AI tools like Chat, GPT, and Claude to research smarter and make better decisions. Quick disclaimer, this channel is for educational purposes only. Nothing here is financial advice. I'm not a financial advisor, and you should always do your own research before making any investment decisions. Now let's get into it. The income statement tells you what happened last quarter. The balance sheet tells you the financial health of the entire business right now. It shows you three things: what the company owns, assets, what it owes, liabilities, and what's left for shareholders, equity. The relationship between those three numbers reveals whether a business is getting stronger or quietly deteriorating. Strong companies build cash, manage debt carefully, collect their receivables on time, and move their inventory efficiently. Weak companies do the opposite, and often for years before the stock reflects it. The challenge is that balance sheets are dense. AI makes it fast to cut through and go straight to the signals that matter. There are 5 balance sheet patterns worth flagging every time. First, rising debt relative to equity or cash. If leverage is climbing while earnings aren't, that's a pressure point. Second, shrinking cash and equivalents with no clear explanation. Cash is oxygen. When it disappears, find out why. Third, accounts receivable growing faster than revenue. That means customers aren't paying, or the company is pulling forward sales that haven't really happened. Fourth, inventory buildup. Growing inventory with flat or falling revenue often means demand is softening before it shows up in the income statement. Fifth, goodwill and intangible asset bloat. Acquisition-heavy companies can mask problems by writing up assets. Big goodwill with weak returns is a warning sign. The first prompt examines debt structure and liquidity, whether the company can actually meet its obligations. Use this. Analyze the balance sheet of company name for the past 4 quarters. Focus on total debt, long-term versus short-term debt breakdown, cash and cash equivalents, the current ratio, and the quick ratio. Has the debt load been growing or shrinking? Does the company have enough liquid assets to cover near-term obligations? Flag any signs of liquidity stress or leverage that looks elevated relative to peers or the company's own history. This tells you whether the financial foundation is solid or if there's a refinancing risk lurking that hasn't hit the headlines yet. The second prompt looks at working capital quality, how well the company is actually converting its business activity into real cash. Prompt: review the working capital trends. 4. Company name over the past 4 to 8 quarters. Examine accounts receivable days outstanding, inventory days, and accounts payable days. Calculate or estimate the cash conversion cycle. Has the cycle been improving or deteriorating? Are receivables or inventory growing faster than revenue? Flag any patterns that suggest the company is struggling to collect cash or is sitting on product it can't move. A deteriorating cash conversion cycle often shows up in the balance sheet quarters before it hits earnings, making this one of the best early warning signals available. The third prompt targets the less obvious risks, the ones that don't jump out from a standard reading. Use this. For company name, identify any balance sheet risks that may not be immediately obvious. This includes goodwill and intangible assets as a percentage of total assets, any operating lease obligations, pension liabilities, contingent liabilities disclosed in footnotes, and the trend in retained earnings versus dividends or buybacks. Has accumulated goodwill grown significantly through acquisitions? Are there any footnote disclosures that suggest off-balance sheet obligations? Flag anything that could represent a future write-down or unexpected cash drain. This is the kind of deep diligence that used to require a forensic accountant. Now it takes minutes with AI. Here's how to build this into your research process. Before investing in any company, run all 3 prompts after pulling the most recent 10Q or 10K. Start with prompt 1 for the debt and liquidity picture. Move to prompt 2 for cash conversion quality. Then use prompt 3 to surface anything buried in the footnotes. You're looking for trends, not single data points. 1 quarter of rising receivables might be noise. 3 quarters in a row is a pattern worth understanding. The goal isn't to disqualify every company with any blemish. It's to know what you own. Surprises hurt investors who didn't do the work. They create opportunities for those who did. A few mistakes to avoid when reading balance sheets. Don't look at debt in isolation. A company with high debt but consistent free cash flow may be fine. A company with moderate debt and rapidly shrinking cash is a bigger concern. Don't ignore the footnotes. The most important disclosures are often buried 3 pages into the notes. Operating leases, litigation risk, related party transactions. AI can surface these fast. Don't assume goodwill is harmless. When acquisitions underperform, goodwill gets written down, and those impairment charges can be massive. Check whether the acquisitions are generating the expected returns. And don't use the balance sheet alone. It's most powerful when read alongside cash flow. That's where the truth gets confirmed. Here's your homework. Pick any company you currently own or are considering. Pull its most recent 10Q from sec.gov. Run all 3 prompts. Then ask yourself, am I comfortable with what I found? Are there trends here I wasn't aware of? Is there anything that changes how I think about the risk I'm taking? You don't need to find red flags to make this exercise valuable. The goal is to know your companies well, so there are no surprises. Subscribe for a new episode every Monday and Thursday. See you next time.